Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. We're climbing up close to episode 100 because of you. So I just want to say thanks. No extra hooks. You know what to do with podcasts, but I really appreciate everybody who listens to this podcast. And I hope you're ready for some good stuff for years to come. This week, my guest is Shawn DiMartile. He's going to talk about his journey from air traffic control to real estate investor, and he's been crushing it. We also talk specifically about the ADU strategy in San Diego, where he is. Stay tuned. It's go time. This is episode 85 of Zen and the Art of Real Estate Investing with my guest, Shawn DiMartile. I think I did it right?
Yeah, you got it right.
Thank you. We were just talking about it.
For getting it right, because that's one of those last names most people don't.
Yeah. So Shawn is a real estate investor with over 300 rental units, and he's only been doing it since 2018, host of the Real Estate Takeoff podcast, co-founder of Takeoff Capital. His focus has been on apartment investing, and he is a Navy veteran. Shawn, welcome to the show.
Thank you so much for having me on the show and for the opportunity to try to provide some value to your audience. I don't take it lightly. Thanks so much.
Yeah, no, really appreciate it. I'm glad that we got in touch, and I'm excited to hear your story. I start in a variety of directions on this podcast, but I'm going to go with my OG question for you. When you were younger, did you have any interest in real estate at all?
No. When I was younger, the thought of real estate or real estate investing never even crossed my mind because I didn't grow up with money, and I just felt like, even just owning my own home was so far off that it really didn't cross my mind when I was younger.
Yeah, that's why I asked, because I feel like it's important for everyone who listens, new investors, old investors, or people just like with a fringe interest, like probably 70% we're at now of people who've been on the podcast who just didn't have any interest. So when did it come to you that real estate could be a thing? Because I know you were air traffic controller before. Mm-hmm. Was it something where you were looking for auxiliary income and then it turned into this?
Basically, exactly that. Years ago, I finally got my dream job at the time, which was air traffic control, and I was making good, high six-figure income. And the thought started crossing my mind because my parents, grew up trying to teach me Dave Ramsey and everything. But I was like, man, I want to invest. Like, I really started to get interested in that. And really the catalyst was just a good friend of mine said, dude, you should check out the Bigger Pockets podcast and maybe think about real estate investing. And it wasn't for like a couple of weeks that I was on a long road trip. I was like, I'm going to kick on this podcast because I'm tired of listening to music. And I started hearing all of these stories of everyday people like PE teachers and, single mothers that were building real estate portfolios. And that was just a light bulb. And I got obsessed.
Yeah, that's so awesome. I mean, I think that's the thing. Even for someone like me who's been in it since I was a kid, I remember when somebody said, hey, have you ever gone on Bigger Pockets? I was like, what is that? And I went on, I was like, holy crap. Like, does this exist? Like, This is like unbelievable. And it's still going. And I think it's a way in for a lot of people. Absolutely. And was it something that you just, I think you were saying it. It's like the thing that I always say, it's like when you see other people who are, not in just like you, meaning like don't have to be an air traffic controller, but like, they just have, they have a job, they're slugging it out. And then you hear like that they're doing it, the light bulb goes off like, hey, wait, this can work for me.
Exactly. Especially whenever you're seeing, I think sometimes like you see like these huge investors that are worth billions of dollars, the Grant Cardones of the world. And for a lot of Americans watching that, they're like, okay, the odds of that being achievable for me are so minute that doesn't really speak to me. But then I remember, for example, my very first ever podcast guest, Anna Kelly. She, I think, has like 4 or 5 kids, was working a full-time job. So was her husband. And when I heard her story of being able to slowly over time with small multifamily build up her portfolio and then quit her job. I hear stuff like that. And as a single guy making good money, I started to think to myself, there's just no excuse. If these people can do it, why can't I?
Yeah. I think that the most important thing, though, and I'm sure they're going to get this from you, is that a lot of people are thinking like the switchover has to be too quick. Like, it's great if you have a great job. Like, don't try to leave the job too quickly. You need the money so you can get more investments. Is that something that you thought about as you were like, okay, I see this extra income coming, but like I have a good job, so I want to make all the money I can till it's replaceable?
That's a really great question because I go back and forth on it. I quit my air traffic control job in March of last year. I wish I would have kept that job a little longer, like maybe another year longer. I mean, with that job, I was making over $200,000 a year, which is a lot of money that you can use if you're smart with your money to reinvest in more real estate.
Yeah.
I quit that job when I had about the same net income. And it definitely like opened up my time. I went on trips and traveled more and stuff like that. But looking back on it, I wish I would have delayed that gratification a little bit more because my investing potential would be double. I mean, it's also hindsight's 2020, right? Like I could have just still been grinding that job while still trying to build a real estate company and just hated my life because I had no free time. So it's hard to say.
Did it have any? I mean, that job is one of the most stressful jobs out there, especially now. They're light on people overall.
Mm-hmm.
So part of that had to play into it. Like, well, I can get rid of a lot of stress. So the earlier that you can release the stress is also going to give you more attention because that's just a heavy job.
Oh man, like I was working. So that job, when you sign on to that job, you're required to work overtime if they assign it to you. It's mandatory. So most weeks I was working 6-day work weeks. My days off were Tuesday, Wednesday. So if I worked a 6-day work week, usually my only day off was Tuesday. And so it's just like it's a meat grinder is what I've heard it been called. So it's really rough and like it was a lot of stress. But I'll be honest with you. I actually think that raising money from investors to syndicate real estate is more stressful for me personally. I feel actually more pressure.
Different kind
of stress. Yeah. I mean, so many jobs out there are stressful, but it's a whole nother kind of stress.
Yeah, no, I think holding somebody else's money and being responsible for it is different. Air traffic control, of course, you're responsible for people's lives, but you've done all your training up until that point, so you can do it the right way. There's a lot of systems in place. As a new person involved in syndication, like a lot of things pop up that you haven't seen before, and then you have to create a new plan instead of using checklists that are already available.
Exactly.
Yeah. So what was the first investment that you decided to put the toe in that got you started?
So the first one, this is going to sound nuts to a lot of people listening to this, but my very first investment was a 32-unit apartment in Greenwood, Indiana, which is about 15 minutes, 20 minutes south of Indianapolis. And in order to get that deal, I partnered with 5 other people, a mix of a couple coworkers, a couple people I met at real estate meetups, and on a joint venture. And I liquidated my 401k in order to participate in that deal and kind of jump in. That was my first deal. A lot of things went wrong, but we ultimately ended up doing really well and tripling our money.
Yeah, good. I'm glad that was part of it because I think you had everybody like nervous. It's like, okay, 4 partners, 5 including yourself, completely out of state, place that you didn't know, and then a liquidation of an account. What made you know before you did that deal that you were ready to go all in like that?
I think it was a culmination of a lot of things. Number one, I had been maxing out my 401k for about 6 years leading up to that, working my air traffic control job. And I was dead set on doing that so I could have a good retirement. Really, the change was the fact that I started to realize how much I was grinding as an air traffic controller and working, like I told you, the 6-day work weeks, and thinking to myself, do I want to do this to retirement age? Do I want to sacrifice most of my weekends because I was going to have to do that for at least another 10, 15 years. Do I really want to sacrifice all of that so I can have this kind of income? And I stopped really buying into the 401k over time because of just, and I won't take up too much time explaining this, but essentially, 401ks are nest eggs. I get it that, employers will match it oftentimes, but at the end of the day, you're capped on how much you can invest in it per year. So, I mean, you can only invest so much anyways. 2, when you reach retirement age, you start selling off your index fund shares or your bonds, whatever it's mixed in order to use that money on retirement. We all know, most of us do, that there's the 4% rule, yada, yada, on here's how you can try to outlive your money. Well, I started to realize with real estate, if you hold real estate and your real estate's cash flowing and you take care of that real estate, it's essentially infinite. You can pass that on to descendants.
Yeah.
And over time, my cash flow increases. So I actually get wealthier as opposed to the 401k. I'm getting poorer if that's my only thing I'm relying on because I'm selling shares over time. So I started to think of all this and just to myself thought, if I want any chance of retiring before, age 60, 65, 59, depends on, when you retire, I have to do something else. And so I bought into real estate and I was willing to take the risk and jump all in order to achieve it.
Yeah, I love what you said. I mean, like, what else can you? I like real estate because you can put money in and then you can get a 2-3x, on anything. If you're doing apartment buildings, you fix up this units. Now you just created yourself higher rents for the next 20 years that will continue to scale higher.
Exactly.
So it's like, there's all these other things where the only way with stocks is like if you're trying to short a stock and then, whatever, you can just watch The Big Short and all the other things that happen. It's not a great principle. Like real estate, you can actually have an impact on your own wealth by doing things that are smart. And that must have been something. Yeah, exactly. But that's also, you're talking about whatever 9-to-5 job it is. When you have the standard job, it's not like there's something you can do other than go up higher, which comes with more responsibility and more stress.
Exactly.
Yeah.
Exactly. More responsibility, more stress. And at the end of the day, you're still restricted on your time. Like they dictate your time. So like one more thing about this air traffic control job, in order for me to get vacation, I have to bid. I have a chance to bid once a year. It's usually around Thanksgiving time. And I would bid based on seniority. It goes in order for all of my vacation the next year. It's hard to do that and plan with friends or family or other people to do any significant trips that far in advance. Like my life was just so constrained to the confines of that job.
Yeah, I understand. I worked for the government for 7 years and I had a little bit more leeway. I was a prosecutor, so we could dial up our time, but you were still counting the time. And then you could max out your vacation time, turn into money. So there's all sorts of different options there. But really, the job never stopped. So it was very hard to go away. And just the last touch on the thing for air traffic control, because I literally just read an article about this. I'm like the biggest nerd. I read everything. And it's at a point now where like there's just no way to train enough people to be in that profession. So it's actually like your old job is probably worth more, but now you have so much freedom with what you did. So I the way that I'm looking at it from the outside is like you left at the right time.
I think so. It's gotten really bad. I feel bad for a lot of the air traffic controllers because the government's just failed to invest into it enough, and it's gotten so bad that now you're going to see it on the news all the time for years to come. You're going to read a lot about delays and stuff just because there's just not enough and they're being overworked.
Right. And it's not like you can just like go to a couple hours training and then like, hey, you're in there. It's that the people in the jobs are so high up.
It's
the
years.
Training takes so long. The funnel's not there. Like They know there's not enough people to come into that. It's interesting though. I think an important thing about that is to know the trajectory of your profession and try to figure out when the right time to go is, because that's a hard thing. You had to know though at some point, like at least when you left, you knew like I have enough money coming in from investments that I can make this decision. It wasn't like a huge leap because you already saw that a funnel could be created that gives you money.
Exactly. Like, I did have, and we were growing our company at the time, and I did have income. I think just, as an entrepreneur, you just have a different stress because you're counting on yourself now. You've got to continuously do deals and grow your company. And if you don't do that, then you could lose income in the future. There's just a different kind of stress, right? Because now it's all on your shoulders. Nothing is guaranteed. Cash flow could decrease for a little while. You could have a little less to live off of. There's so many things that could go wrong. So I think you basically, as an entrepreneur, are trading that security for a ton more upside potential, but it's all in your hands now.
Yeah, exactly. And some people aren't ready to do the work, or they also don't realize like you're not just going on to Hawaiian vacation when you could become an investor. Like it's a full-time job and then some, but it's just a different kind.
Exactly. I couldn't have said it better myself. Exactly. It's not like I'm not still working and grinding. It's just on my own terms at least. And I'm telling you, I would prefer it this way as opposed to working as an air traffic controller.
Yeah, exactly. Dropping back on your first deal for a second, how did you guys decide on Indiana? Where did the deal come from? And then how did you all collectively fund it?
Good question. So the reason why we decided on Indiana was largely because here in San Diego or in California in general, the barrier to entry is a lot higher for one. So guys like us, like we had, the property we bought for 1.2 million. And it was 32 units in Indiana. With 1.2 million in California, you can, at the time, could have maybe gotten a duplex.
I don't even think so. I tried to get a threeplex and a triplex in Encinitas, and it was like 1.6. And this is still that was like 12 years ago.
It's crazy. Exactly. So to be able to do, even if you were to get like a triplex or something like that here, like you're not going to get as big of a pop. Like maybe you can. It's just a different kind of play and something that you're not going to joint venture on with 5 people usually. So the barrier to entry had a lot to do with it. But then, so we knew we wanted to go out of state. So when we were looking around out of state, we wanted to pick a place where we could get in as newer investors with a little bit less competition. We could buy a certain size property to where we could still get that economies of scale. So we kind of narrowed it down by that, and then looking at, okay, what cities do we see or neighborhoods do we see that still have good job growth? Still, like, for example, Greenwood has a really high median household income. I think at the time it was like $65,000, which for that part of the country is great.
Yeah.
Still low cost of living, a good mix of jobs, low crime. All the schools are rated 10 out of 10 or 8 or 9 out of 10. It had a lot of good things going for it, and it was growing. And we picked like that in Louisville, Kentucky, a couple other places. And we got the deal by networking with brokers. This deal was sourced from a Marcus and Millichap broker, mom and pop owner, with a lot of deferred maintenance. It was a clear value add play with market well below rent. So that's why we decided on that market, that property. And was there any questions I forgot to ask?
The funding.
The funding was all ourselves. We brought in no passive investors. This was me and the other guys that came together. We had varying amounts and just split the property based off of equity percentage.
Yeah, nice. I mean, that due diligence on that property for a first-time subset of investors is good because you focused on the right things. I feel like there's a lot of shiny objects in investing as a whole, but even with deal flow, when you're new, it's like someone will just email you, like someone will send me like something random, and they're like, "Ooh, Arizona! Like, I got to get this," and you're like, "Wait, yeah." You don't even know Arizona.
Yeah.
Like, let's do some research on the parts. It's like when somebody says, "Oh, I'm thinking of investing in Texas." I'm like, well, I mean, do you know how big Texas is?
Yeah. And do you know how much competition there is for you right now? If you're a multi-family investor, it's you and everybody else. Why are they going to send you the good deals? There's a lot of things to think about. But I'm a data geek and a data nerd. And this is one of the reasons why I really look up to people like Neil Bawa. The more data I can get, the better I feel about an investment. So when I'm putting my deals together, I'm looking at so many things. I like to look at all those metrics I mentioned before. I'm looking at graphs of cap rates over time, all sorts of stuff to come up with whether or not I feel comfortable moving forward. But I think data is the most powerful thing. And one of the reasons why I love real estate, you've got clear data you can look at that can be translated into decision-making for your investments, which is way easier to do to me than stocks.
Yeah, I agree. I'm a big data nerd as well. But what helps you get out of the analysis paralysis stage and then into action? Because I think that newer investors, they really pound data too much. It's probably because they're scared and they lack confidence. But what did you know about running the data that helped you finally get to the conclusion? Possibly it's the market, because the numbers, you're like, oh, wait, this actually works.
I think for us, it was just knowing that we're going to be able to cash flow. If you're cash flowing quickly in a deal, it can be a lot more forgiving, and you can, and just in a lot of ways, as long as you can pay the bills, then you can make it out on the other side. Whether or not you're going to make a 3x return or just a 1.2x return, is going to be dependent on your ability to implement the business plan. But I think just the fact knowing okay, this is our first deal, we're going to make mistakes. Let's go ahead and move forward with this, knowing that we can cash flow this deal so that we can learn the ropes a little bit. I think that was for that deal what made me want to pull the trigger. And also listening to so many podcasts and starting to host our own podcast, hearing so many other investors that came before us saying that you've just got to get in there and get started. But nowadays, what prevents me from having analysis paralysis is that combined with combined with being well capitalized. If you're not so worried about running out of money on the deal and you feel confident with enough contingency capital, it makes me so much more comfortable to move forward on a project.
Yeah, that's a great point. I feel like the more you understand your financing, the more leverage you have, which means you're going to get a better deal. So if someone is at the top, they're going to be desperate to get it and they're going to be pushing right up. If you have the money, I always say the best asset you have as an investor is the ability to walk away. So if you know your capital and you can be like, yeah, well, we're good at 1.3, like, see you in a couple months, it's not going to sell, and then you get it for less. That it's because you're very clear on your finances and that you can hold on to them.
Exactly. I think a lot of new investors, I understand the analysis paralysis because a lot of new investors are getting their first deal and it's their entire life savings that they're investing in. And they're thinking to themselves, if something doesn't go wrong, what am I going to do? I don't have somebody to turn to get money, and I don't have any money left over myself. So I understand that because you're not working with a lot. And if it goes wrong, that's all you got. So I get it. It's really hard on those first couple deals to not have analysis paralysis.
Yeah. Didn't it help also to have 4 friends, colleagues in the boat with you? So it's like, okay, we're all doing this together. You collectively are all like, hey, we're good. Like, is this good? You have other people to bounce it off.
Yeah. And you feel like mistakes could be caught, a little easier when you've got that many heads coming together, all people that have studied real estate, have some level of understanding. That'll make you feel way better. So I think that's another good point is, joint ventures, getting business partners on your first couple of deals helps you, especially if they've got experience, will help you avoid some mistakes and catch things that you might have missed all on your own.
Yeah. And I would say from my personal experience, I used to say like, oh, I really don't like partnerships. But the reason why is because I was traditionally just the way that I grew up. And when I was investing, I was always the source. So I had a lot of people who wanted to partner with me, but like it wasn't an equal partnership. I was usually the money and they were the work. And so there were more people trying to like get one over on me. So I became like soured on it. And then now with the advent of like, sure, even on bigger pockets, you have to wade through and figure out, but then you get to in-person meetups and you're like, wait, these 4 people aren't bullshit. Like this actually, I've found now, like I have like unlimited partners out there that I'm interested in doing deals with, but it does take the time to go through that. What made you sure that these 4 people, that you guys were like all on the same page? Because I feel like that's something where people get nervous and you have good experience, 32 units, 5 total people, that's a lot to put together.
Absolutely. And I want to start by saying this. I just don't think it's possible for you to not have some disagreements with business partners, right? So if you're listening to this podcast and you're thinking that whether or not you want to get a partner and maybe something that's holding you back is the fact that you don't want to have to compromise and you just know there's going to be disagreements, that's just part of it. To this day, I still have disagreements with business partners on certain, maybe resolutions to issues or certain things that we should do or not do. But I say that now, what made me feel a little more confident with these guys are that 2 of the guys I worked with, and we had been at work all the time in air traffic control, discussing real estate, trying to plan for a multifamily acquisition. So I knew them well, and that made me feel better about it. 3 of the guys were coworkers. The other 2 guys, one of them was already an experienced real estate investor. He had actually been a guest on the Bigger Pockets podcast. And while he played less of an active role, just having him there to bounce ideas off of, definitely made me feel a lot better about it. So we did have somebody with some multifamily experience, but ultimately just, I'd been to multiple real estate meetups with these guys and had long conversations. So I think that just I knew them well enough to know what their strengths were and know where the synergies would be.
Okay. Yeah. Awesome. Before we get into this interesting niche that we're going to talk about with ADUs in San Diego, one more thing on that deal. I like what you said before because you were focused on cash flowing, but for a lot of people, they're buying cash flowing deals that are like D neighborhoods, high cash flow, lot of deferred maintenance. You knew going in there's some deferred maintenance, low rents, but you looked at the data and saw like that's not a cash flow D. That was probably like a B- or something, or a C+, right?
Yeah, I mean, this neighborhood was like a B+ neighborhood.
Oh, wow. Yeah.
Whenever, like the old adage in real estate, buy the worst house in the best neighborhood or the ugliest house. This was the ugliest and worst apartment in that neighborhood.
Yeah.
But when you can change a property, you can't change a neighborhood. Another old adage of real estate. A great location, if you can add a ton of value to a property in a great location, you'll do really well. I could go on and on about my thoughts on location and buying D-class assets and tertiary markets and all this other stuff. But I think that there's a lot more risk, in my opinion, in a bad neighborhood, even if you got a good property.
Completely agree.
Good neighborhoods are going to appreciate better. You're going to get better tenants. The list goes on and on and on. And the cap rates swing less in good neighborhoods. I think that if you're listening to this podcast, yeah, you might be able to afford a Class D property in a Class C minus neighborhood, but that might not necessarily mean it's the best investment for you.
Yeah, and completely different management styles. D to C minus is going to be like much, much more. You're going to have to pay more and manage more. So you just have to know like what you're up for. Some people may, if you're really good at that, you're going to make a ton of money, in D plus class properties. But like
Absolutely.
You have to be good at it. You can't go in as a slumlord, because the whole point is to help the neighborhood get better, because then your long-term appreciation will get better as well without over gentrifying. But B plus, like you said, you're walking into something that, sure, maybe it's kind of dumpy for the area, but that means everybody wants you to succeed.
Yeah.
They want to get rid of, when you buy the worst house on the best block, everyone's like, oh, like, let's go. Please flip this house.
In fact, when we replaced all the second story balconies for this property, because this is a 1968 build, they were sagging and stuff. We replaced every single one of them. When the building inspector came to inspect and give the certificate of occupancy, he actually said that a lot of people within the fire department, his friends, and a lot of people in the neighborhood were talking about how happy they were that somebody finally came in and fixed that place up. So yeah, a lot of times you can make the community very happy from going in and doing something like that.
Yeah.
Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me, direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there.
All right, let's change gears, because this was interesting to me when we connected. Why does San Diego have something that's different than other places in terms of ADUs?
So the reason is San Diego has a very unique problem. So here in San Diego, California, the city is geographically constrained. You've got the Pacific Ocean to the west, Mexico to the south, mountainous terrain to the east, and then Camp Pendleton military base to the north. So over time, all of the flat buildable land, all of the mesas have been taken up with housing. Yeah. So there's nowhere left to build really for the city. It has the least amount of buildable land in the country, next to a couple other cities like Miami and somewhere else. So the city's been growing. The job growth has been exponential over here. It's now the third largest biotech hub, and a lot of people from the Bay Area are moving down here. So you've got population growth, but the housing growth isn't coming with it. So now, the median home price here is just under $1 million. I think last I checked, it was $960,000 for the median household income. On average, 17 renters are competing for the exact same apartment in San Diego. So there's a huge supply and demand imbalance. And that's the case around a lot of California. And so this is why they came up with these accessory dwelling unit laws in the state. Now, San Diego, because their problem is so bad, took that a step further and created what's called the bonus ADU program. So essentially, you can build an unlimited number of accessory dwelling units where a single family or multifamily existed before, up to the floor area ratio of that lot. So, depending on the size of the lot and its location, and just to because people, I'm sure, are thinking like, wow, you can do that anywhere. Only in certain areas that are zoned transit priority areas. But through a lot of the city, you can do this, and you can take a lot and put a 20, 30 unit apartment complex on it. So,
so it's not like
I think the traditional thought of ADU is like, hey, I'm going to knock out a tree house or like, a she shed in the back. We're talking about things that can be bigger.
Exactly. We're talking quite literally, they look, feel, sell, trade, get lended on exactly like normal apartment complexes. So 3-story apartment complexes that have, 1-2 bedroom mixes. I mean, in every way, think of these accessory dwelling units as apartments. The difference is just in the municipal code. So if you were to buy a vacant plot of land and go through the traditional permitting process to build a multifamily development from the ground up, there's going to be a lot more hurdles for you to go through.
Yeah.
You're going to pay more fees, development impact fees, and things like that. But the city wanted to increase this density. And so they created this new municipal code and they fast-tracked the permitting process. Fast-tracked, it's supposed to be faster.
Yeah.
And all these other things in order to make it easier for developers to increase density. So they are apartment units. It's just the way you build them is a little different.
Yeah, and I'm sure you have to accommodate for the parking and those things, but yeah, I mean to me that kind of reminds me a little bit more of self-storage than anything else, because for self-storage, your biggest value add is like, can I put more bays in? Especially for like Midwest self-storage, they're just like rows, and you're like, well, there's 2 extra acres, and you're like, well, I mean, that sounds good. I just put the same structures in on the same property, and like you said, they've already built something there, so they're like, ahead of the curve.
Yeah. And there's a couple reasons why this strategy, because up until this strategy, I wasn't really investing in San Diego or California really at all for a number of reasons. Here, the typical multifamily will sell for $450,000 a door plus, depending on where it's at, et cetera, right? Close to the beach, you'll see properties selling for $600,000 or more per door. You can build these ADUs or build new units for, on average, around $200,000 per unit. And they will sell for, like I said, $450,000 plus per unit. But in addition to that, what I really love is that you're buying a property that's already got an existing structure that you can rent out and produce some kind of income. So traditional development it's a lot riskier because you're going to build those huge apartment complexes. You're going to buy the land and then submit for permits. And while you're waiting and working with the city for several years, you're not making any money. You're burning through money, paying off mortgage, et cetera. With this strategy, you can buy an existing house and, best case scenario, rent it out on Airbnb if you get a permit and produce substantially more income to cover your holding costs while you wait for permits. But even if you just make it a long-term rental, you've got money coming in. So that's just one of the biggest risks of development that you're able to mitigate by doing something like this.
Yeah. And I mean, like, sweet extra to have for homeowners who are in the area who have extra space, who didn't know what to do with it. And now they're like, okay, I can either sell where someone's going to pay up for the property because they can do that, or they can try to, at least partner with someone who wants to do it themselves and, give up some of their land, but get a whole bunch of
which is
later
the
income.
Strategy we're trying with sellers right now.
Yeah. I mean, I think that's a good pitch. I mean, it's a pitch to either partner or, hey, you don't have to do it, but like we can overpay you for this now because we're going to do this.
Essentially, because so many sellers, even if they're absentee owners or rental property owners, are really wary about selling right now because they're like, yeah, man, I'm going to have to sell right now when I don't think it's the best time in the market to sell. And then where am I going to place this capital?
Yeah.
So part of our strategy, we're actually sending out mailers like, hey, your property meets our criteria, we're interested in buying, whatever. But we're also saying, hey, are you if you don't want to sell right now, would you be interested in partnering to where we buy it with an LLC, you become a part of that LLC, you'll get some money today, but we give you a piece of the equity to where instead of making $1 million selling your home, you could stand to make $1.4 million over the next couple of years. Like
and reduce the cap gains. I mean, because you're not going to go all in on a full sale like that.
Exactly. So I think today that's just a lesson too for people listening. Deals can get done. You just got to get really creative. I mean, we got a project going right now where we're building a 10-unit apartment where a single-family home existed before. And we were able to get seller financing. And there's all these creative things we put in there. I think, deals can be found. You just got to really tinker around and get creative.
Yeah, I agree. Again, it's another thing like growing up, I didn't do seller financing. But my dad did because he would take any opportunity to just try to save his own money, so he actually used it. I just didn't really get the principle. And now, you go through a couple market adjustments and you're like, well, now this is starting to make sense. Now you have a pitch for seller financing, when before it was like, I don't really have the best pitch, for it. This is cool though. I mean, I like the idea of offering sellers like a partnership option, especially if they're absentee and they just have that place rented anyway. They don't like the
It's
tenants
hey, what's your cash flow right now? We can give you more than that cash flow that you're making, and then you'll make even more money on the back end. So a lot of times you can make it a win-win. I mean, even with the seller financing, it's a lot of the times you just got to educate the seller that might be a little wary because they have no idea what that even means or what that entails.
It sounds like a scam until you explain it. I mean, like you're gonna, great, no cap gains, like especially like less down payment, less cap gains, like that works for us. But also, I think that's the seller financing is the best on all levels because you can basically pay them what they want. And I mean, that's the whole goal. They just have this number in their mind. Oh, whatever. I can pay you whatever you want. I'm just going to structure the payment in years and low down payment where it's going to work for everybody. So they can walk away feeling whole without being tricked also.
Exactly. And, also making sure that they understand like, hey, by the way, your risk is really low in this case because you're playing the bank, which means that if we do default on this, you get the property back. Granted, you got to go through foreclosure and no one wants to have to go through that process, but you would have rights to this property back if we don't pay you this debt. And like you said, you can pay them more. So this seller was wanting way more money than we could afford to buy with today's interest rates and the loan to value we were going to get. And we explained that to him and said, look, we'll come up this many hundreds of thousands of dollars in price if you can do the seller financing. Yeah. Here's why this would work for you. Here's how much money you would make over the next couple of years.
But they stopped listening when you said it will go up 200,000 over what you thought you'd get. They're just like, this sounds great.
Yeah, right. Yeah.
Just show me where to sign. We seller financed one of our commercial properties in New York, and it was great. It was a like a mini mall, a mini plex, and we sold it to the guy there who owned the deli for like 20 years. But like and we actually seller financed my dad's old office building too. And both times the whole time my sister's like, this is great, we're getting income. I'm like, I want them to default. I want them to default. And then on my dad's office building, he was like way, way behind. And we started foreclosure proceedings and we were like, oh my God, because he had been paying for like 10 years. So we're like, and now the property's worth way more. I'm like, this is going to be the biggest windfall. And then like literally like 2 days before the court hearing, he like paid it off. And we're like, it's the only time you're like depressed to get like 900 grand. You're just like, I thought we were so close to just doing a reset. Like we're just going to start this all over again and sell the property again. So yeah, I think now more than ever, investors can see that there's opportunity. You just have to really understand like how each one works, or else you're not going to be able to pitch it. And you probably will sound like it will sound like a scam.
Exactly. And just always remember, if you are going to pitch something to somebody and you're listening to this podcast, they don't give a damn about you or how it's going to benefit you. Like, just make sure that you're outlining to them and educating them on how it's going to benefit them, how they'll make more money, how little risk they're going to have. Focus on them. They don't care about you. So keep that in mind.
Yeah. And I think that's the biggest original pitch, 20, 30 years ago on seller financing was no capital gains. Like, and then that's what helps. I mean, I can give you a 50% down payment, but you're going to pay capital gains on that. They're like, oh, well, that sucks. I'm like, so let's just make it like small, and then make payments, whatever, higher. It doesn't matter. Yeah, I love it. And I think it's interesting to know that you can do that on a much larger scale. And actually, that's going to be the way that a lot of people are going to have to do it. There's not going to be a lot of options for sellers on large scale commercial. Their loans are getting called. There's not a lot of buyers. They're not meeting on price. So the only way to meet on price is to do seller finance.
Exactly. And I think it's going to be like that for a little bit longer. So it's one of those things where, like, also keep in mind, if you're listening to this, most people are going to say no, even if you like are a great salesperson and can explain it really well.
It sounds fake.
Yeah. It's going to take a lot of trying before you find somebody to say yes. I mean, tons of people have told me they're not interested and just shut me down and don't even want to hear it. That's just part of it, man. Like, that's how it's going to be.
But that's off-market acquisition. I mean, if you can't take no to your face, like, you're never going to get good at this. And I mean, to me, like, the way I got good at off-market is I always took no and then I kept following up, but I never asked about the property. And they were just like, oh, and I wasn't being fake. Like, I want the property, but like, they seem cool. I'm going to try to help them over the time. And eventually they will understand it, or they'll at least ask you questions. And then they're more likely to tell you, listen, I'm still not on board, but I have a friend. who owns a 26 unit, and they've talked about seller finance.
Exactly. And you just like you'll learn from doing that. Like you're going to learn a bunch of things. You're going to learn like what it is that makes people say yes. You'll learn like what it makes people just hang up the phone on you or like never get back to you. You'll learn over time, and that will make you become a better salesperson, a better marketer, a better negotiator. For me, it's just been learning from experience, because I definitely sucked at it when I first got started.
Yeah, but that's a great point too. I mean, you need the reps and you need a bunch of no's to your face to understand like, well, it's not me. I mean, sometimes it is us in the beginning. You make a bad pitch and you walk out and you're like, I really shot the bet on that one. Like, I just didn't sound good.
My pitches to investors and building pitch decks, like my first ones weren't that good.
Yeah.
I wasn't very good at speaking to the investors during the webinars and stuff. All of that stuff gets better over time. Just treat it like sports athletes do, right?
Yeah.
They watch tape, record your webinars and things like that. Watch it and then critique yourself. And then same thing with even mailers. I mean, you're not going to record it, but like you can at least look and say, okay, let's do something different. What's working? What's not working? It's really just about tracking everything and doing what works. I mean, that's the day.
I was about to say that's where, our obsession with data helps though. Sure, you're mailing postcards, but how do you know what happens? You don't know who actually picks it up and reads it. There's no data on that. On the calls. So you track those, and whichever ones get more calls, and you just do more of that.
Exactly.
You get no response, do less of that. But I think, there's so many things out there and so many products being pitched at real estate investors. Like, we'll do all this for you. And there's some of those companies are great. Some of these marketing companies way better with the postcards than others. But like, it's a lot for a new investor. So they're going to sign up, spend something, but I think they always just expect it to work itself. And it's like, no, you have to look in the back end of the site and see what's working. They're not going to do that for you.
Yeah. And I think a lot of people also don't realize stuff like that takes time. Like if you talk to anybody that's wholesaled or gotten deals off market, they're marketing to those people over and over again. It's not like they send out one postcard and all of a sudden people start like your phone rings off the hook with people wanting to sell you their house. That's not how it's going to work. What's going to happen is you might get a couple people, depending on how many mailers you sell out, maybe a handful that actually reach out to you, maybe not, depending on how good your mailer is.
Yeah.
And then sometimes the people that reach out to you still aren't interested, but you're going to learn the kind of questions they're asking so that you can better target people like them. It's just, you're going to basically have a crap load of no's with a very low conversion rate before you start seeing success.
Yeah. I mean, I think the data that I used to look at said 8 months for mailers, and it does make sense. But that's the thing. If you have a limited budget and you think like, well, I'm going to do postcard mailing, you only have enough for one postcard mailing, like don't do postcard mailing. Mm-hmm. Like you need to at least do 6 months on those. And then really you want to keep doing it. Because you take the returns, you remove them, so you're averaging down each time. You take all the FU calls and you say, put them in a different list. Maybe like I'll send them one in 4 months instead of like the next one. But I think like people don't want to manage that part. They just want to just let it all go, which is fine. If you have the money and you could do large scale, like have at it. Your numbers will be okay. But you can also take in a lot of bad calls,
Yeah, and there's also like cheap ways of doing stuff. Like obviously you could drive for dollars, or you could even satellite for dollars. Like what I do is I sometimes will like look on the satellite view because I'm looking for very specific properties with lots that are very specific to be able to let me build. And I'll look, and then you can write a handwritten letter and put it on their front door because I guarantee they're going to do that. Obviously, you can't do that with a list of 1,500 people. But you can at least get started and start finding a way to get these people to read your letter or knock on their front door or something. There's always ways to do it without having to spend thousands on marketing.
Yeah, I agree. And I'm much more for micro marketing. Like I'd rather obsess on the list, look at the list, pick out like the top 10 and just like really write something that they're going to read. You'll get a way better return on that. It's a no-brainer. It's just that most people are, don't want to do the work.
Exactly. Yeah.
Yeah. So if someone was like a new investor like you, it was like 2018 when you got started and they were trying to figure out how to get into the market now, what to do. What's some advice that you would give someone who's new to investing now to like, get started without falling in the traps that a lot of people do?
I think that the number one thing I would say is obviously, well, other than the obvious stuff like education and studying very heavily, because that's always going to be number one. I always think it's really great to go to real estate meetups. Because you can go to the local real estate meetups, and even better if you start your own real estate meetup. And the reason why is because when you start a real estate meetup, everyone wants to meet you. So it's less work if you're an introvert on like going up and saying, introducing yourself.
Yeah.
It's a lot easier because when I was hosting my own, everyone's coming up and saying, oh yeah, are you the host? Oh, thank you, blah, blah, blah. So anyways, going to those places will help you meet other investors that are doing different strategies in your market. And if you build a rapport with these people, it's a lot easier to learn from people that are doing a great job in your market to help you get started. That's also where you could potentially meet partners so that you'll find other people that are like, yeah, I only got about $50K. I can't afford a down payment right now. Oh, me too.
Yeah.
I always tell people to go to real estate meetups because I think that that's where you're going to be able to network and grow. Now, outside of that, my advice to newbie investors trying to get started, if you can get a mentor, get one. And then the third piece of advice that I would give to people is just realize that it's going to be tough right now. Movement's going to be slow. It's not 4 years ago where everyone was making tons of money and it was really easy. It's going to be tough. It's hard for me right now. I'm struggling to find deals. So I'm just saying that because you got to realize that and take it in stride. It's not going to be easy right now.
Yeah, I agree. I mean, I love what you said about meetups. I talk about it all the time. I mean, I think that's the camaraderie and confidence that people need. It's the one thing that you need outside of books and podcasts to take you to the next level, because until you see people like yourself doing deals, and I always say this, I've said it on a lot of episodes, it's like people don't know, like they think like investors are all pulling up in like Lambos and you go to a meetup and you're like, that, like that guy?
The guy wearing New Balances with a tucked in shirt.
26 units. You know what I mean? And he's like, yeah, I'm just getting started. I just pulled, 4 families, the other week. And you're like, what? And that's where I think it really starts to say, just like you said, you're listening to these podcasts when you first got started, you're on a long drive and you're like, wait, I mean, that's just like, I got a 9 to 5, I want to get out of that too. And that's where it changes. And that's where it's like, books and podcasts will get you a lot of places, but you really need the other people to show you that like, it's not that hard, but also like, at a time like this, let's not rush into it. Let's just try to learn as much as we can. Great advice.
Exactly.
Yeah, awesome. So where's the best place to find you? Is it at Investor Shawn, and that's SHAWN.com?
Exactly. InvestorShawn.com is where you're going to get all kinds of resources. I wrote a free ebook on this whole bonus ADU strategy in San Diego. So you can kind of learn more about that. Totally free. You can also access my newsletter, things like that. But if you're listening to this, do me a favor and go, if you have an Instagram, follow me on Instagram, because I also put out daily content there and I work really hard on it. Shawn, SHAWN _DiMartile, which I'm sure will see how to spell my name on this episode, but it's DIMARTILE. And you'll be able to follow along with everything if you do that.
Yeah, that's awesome. Instagram is like a great place. There's definitely a lot of shiny objects on there, but sure. I think like once you follow the right people, your feed is just full of like all good stuff.
Yeah, I mean, I'm telling people all kinds of ways that I use to like save money on renovations and things like that. I mean, it's actionable stuff that you could do like in your own real estate investing.
Yeah. Awesome, man. Well, thanks so much for coming on. I'm glad we got to meet. It was a pleasure to have you.
Thank you so much for having me on the show. And if you're listening to this episode, Jonathan's going to come on my podcast as well. So you guys will get to hear him tell a little bit more about his story.
Yep. And that is, so give us the name of your podcast. Of course, they'll find it on all the places that we all listen to all of these podcasts, but I'm going to be over there soon. So give them the info on that.
Thank you. It's called The Real Estate Takeoff. Remember, I was an air traffic controller. We just incorporated that in the name. So The Real Estate Takeoff, you'll find it on iTunes, all that kind of stuff.
Awesome. All right, man. Thanks so much. Look forward to staying in touch. All right. That was episode 85 with Shawn DiMartile. I'm Jonathan Green. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.